Uh, Good evening, everyone. Uh, Thank you for joining today's webinar on underwriting multifamily value add deals in current market. Feel free to share like whether you're active investor or passive investors information, and also how many deals you have underwritten so far. That kind of information. So, and disclaimer, this webinar is provided for educational purpose only. You are free to accept or reject all investment recommendations made by us. All services that we offer are subject to market risk and may result in loss to your investment. Please consult a professional advisor before investing. Uh, and also, I'm sharing this information based on my experience underwriting in my target markets. Like I'm out of Greensboro, North Carolina, so I focus on North Carolina markets and South Carolina markets. So most of my underwriting in these markets. So all assumptions are based on these specific markets. So you can apply same concepts to other markets, but you have to do your own due diligence. And topics we'll be covering today, gain understanding of what makes a good deal through underwriting strategies, understand the value in rent roll and T12, financing options, rent projections, loan to value or LTV, capital reserves, real estate taxes, insurance, DSCR, and a few other topics also will be covering. Feel free to pose your question in chat box. I will address after presentation. So it will take around 15 to 20 minutes presentation. Last 10 to 15 minutes will allocate to Q&A sessions. Okay, so a little bit about me if you don't know me already. So I'm founder of Usha Investment Group. I'm out of Greensboro, North Carolina. So far, I have invested as a limited partner in 1,000 plus units and general partner in 64 units. Underwrote like more than hundreds of deals in these markets. And also, I'm organizer of multifamily AP360 virtual conference. So far, I have organized 2 virtual conferences and also host of multifamily AP360 podcast. So far, we have published 330 plus episodes and also author of the book Creating Wealth Through Passive Apartment Investing. So let's move on to next slide. So we are mainly focusing on value add deals. So what is value add deals means? It's like occupancy rate is at least 85%, and there is opportunity to improve or add value to these apartments by operational side or renovation side, interiors or exteriors, those kind of stuff. uh, I will take one example of an underwriting model, and also I will walk through each and every step. So before going to that, so let's uh, I will ask one question to you. Also, you need to just type in the chat box. So, what makes a good deal for you? You know, just type whatever comes to your mind. We give few seconds. So there are so many other parameters also we can include, but as per my understanding and my knowledge, a good COC returns at least 6 to 10%. So again, based on market and based on investors' needs. And from IRR point of view, at least 15 to 20%. Again, subject to based on goals of you and your investors. So we need to consider all these factors. And good market, good sub-market, and also stable cash flow in any market conditions. We can apply a few other stuff also. Yeah, less risk, more return. Yeah. Yeah, that is also a good point. Yes. Okay. So I will take one deal that I underwrote last year. So I will walk through that deal, and if you have any question, feel free to ask. It's a 160 units deal of South Greensboro, North Carolina. So normally we'll get deals from brokers, or most of the time I'm working with brokers. So brokers will share operating memorandum, T12 and rent rolls. So OM is like operating memorandum. So an operating memorandum will get about they will share information about market and sub market, and also about property information, and also financial information about property. So let me share few stuff from OM. So you'll get some idea about how many units, which year it was built, what's average unit size, occupancy, and average market rents, location, those kind of stuff. And also little bit about what is the value add on that particular deal, and what is the value add component, how much rent bumps we can increase, um, and also about market, location, property summary about uh, building, how many number of buildings, structure, roofs, systems, HVAC, plumbing. So yeah, so I will go through all this information before underwriting any deals, and also will get some rental comps information also. A few things I will pick up from here for our underwriting purpose. So these are the stuff. So unit breakup, like how many unit type, number of units, size, market rents, and also value add components, how much broker is projecting, how much renovation cost per unit is projecting, how many units we can renovate, and post renovation, how much premiums we can achieve, those kind of stuff I'll get. So, and also I will share underwriting model. So this is one component, and also we will get T12 and rentals in Excel or PDF format. Uh, I'll move on to Excel, underwriting model next. So this I'm using Michael Blank's underwriting models. There are many other models also there, but I'm comfortable with using Michael Blank's underwriting model. It's called SDA. So from broker, we'll get the whisper price or asking price. So I enter those information here, 125 125K per unit. And also from, I will input all the rent roll and T12 information here. So from rent roll, so I will get the number of units of each unit type, and also what is the average rent, average effective rent, and yeah, those kind of information I'll get. Mainly I will enter here. So this is like uh, unit type and rental mix. So there are 70 classic units, square feet of 700. So currently average rent is 725. Always I will take this, always we need to take these current rents from rent roll, not from OM operating memorandum. So this will reflect accurate information. Rent roll reflects accurate information. So that's why I will get from, uh, rent roll. And there are some renovation units, and post renovations is achieving 896, and there are two bedrooms, 36 units, 1000 square feet, achieving 860. Some renovation units achieving around 984. So I will enter all this information and target rent. So there are a couple of components when we are entering target rents. So one is like market rents, and also other is based on our business plan, we need to decide these target rents. If our business plan is just achieving market rents, then we need to enter that. And if our business plan is renovating those units, we need to enter those on these premium rents here. Okay. So there are some partial renovations, they are achieving only 896, but why we are entering 1075? Because we are doing some post interior renovations or exterior renovations, and based on our business plan or research, we are projecting we can achieve this kind of rents. Same with 2 bedrooms also. Then what is T12? So what you get from T12? So T12 is about overall income and expenses about that particular property. Okay, so we can see gross potential rent on 12-month basis, break up by each month, and also how much concessions that particular property, and also vacancy, current vacancy, and what kind of other income we are getting. All these details we'll get from this current T12, and also expenses by different category like advertising, marketing, general admin, contract services, repairs and maintenance, turnovers, payroll, insurance, or utilities, and management fees, real estate taxes. All this information, these are like all T12 expenses. Okay. So based on this, we'll input all these data into our underwriting model. So income side. So these are like first line is all about T12, getting from current T12 model. So we'll be entering gross potential rent, vacancy, concessions here. This is total effective gross income, line column C. And also these expenses also we're getting from T12. All that. So that's it. And most of the time, I underwrite deals based on T3 income and T12 expenses. So we have other columns like T6 analyzed, T3 analyzed, and offer. So T6 also we collected all the information. So T3 is like T3 overall effective gross income is 1655 something. So here itself how we can get that one. So we'll take last 3 months of gross potential income or total income, and we'll multiply with 4 times. That's how we'll get. So we'll take 3 months total income and we multiply with 4 months. So that's how we'll get this T3 annualized effective gross income. Okay. And this is our our like pro forma kind of effective gross income. So we are saying like, so we'll implement this kind of business plan. So this total average monthly rent is coming from here, our target rents. Okay. And also first year we are saying we'll go with 5% vacancy. That's almost similar to T12. And our last two lease is a little bit higher because we are planning to do some kind of renovation. So we can expect, some last two leases on year ones. And expenses, this is very, very important. So some of the components will go with industry standards. and few components like insurance, real estate. These are very important components. Normally, insurance rates are growing up like most of the states, specifically like Florida and Texas markets going like anything. But other markets, always, we need to consult with insurance broker and get the quote. Uh, and real estate tax also is growing like crazy in some states, and maybe in North Carolina every 4 years they will do reassessment. So always is good practice to reach out tax assessor in that particular county and get the value, like what is the millage rate and when exactly they will be reassessing the taxes, and what will be the assessment value. So like here we are getting some assessment value and millage rate this particular county. So every county it is different. So we need to get those values. And also, so we need to validate these expenses and rent projections always with a local property manager. So that way we can go with very confident before submitting LOI. So we need to validate property management fees, how much they will charge. So it depends, like below 100 units is different and above 100 units different. Most of the time below 100 units it a little bit higher, but if you go with higher units like 100 plus or 200 plus units, it's a little bit less, like 3% or something like that. And payroll also one important component. So standard is like maybe 200 to 1500, but nowadays this payroll cost also increased like anything. It's touching almost 1400, 1500 range. Again, it depends on state, at location. Each market it is different, so we need to get this information from property managers. And also like repairs and maintenance turnovers also we need to validate with. Normally we will go with historical expenses, and also we need to check with baseline these expenses also. So yeah, and few other components, right? So I'll go back to PPT, and so these, okay. So what value we are getting from rent roll and T12? So current market rents, lease trends we can get from rent roll. What are rents trending in last 30 days, 60 days, 90 days? Unit type, size, restart, lease ends. T12, from T12 we'll get potential income, concessions, LTL, vacancy, other income, this stuff. Income trends last 3 months. So then we'll go to important topic like financing options. So there are a couple of options like bridge option and permanent agency loan options. So till last year, I used to underwrite a lot of deals with the bridge loan. So with bridge loan, mainly bridge loan we use it for repositioning of any like unstabilized deals, and it's a short-term loan. Like normally we'll get for 6 to 3 years, and sometimes you can get 6 months or 2 years 1 year extensions, and only with interest only option. Normally interest rates will be higher with bridge loans. Yeah, mostly will get interest only. Nowadays, like last year, it was a bit lower and like around 4%, around that range. And also we need to purchase rate cap during that time period. So that rate cap also now it's crazy. So it's very high cap rates. So now interest rates also very high, like more than 8%. So most of the deals I'm underwriting is bridge loan is completely out of scope. So, and also we'll get high LTV with bridge loan, and also we can get 100% of capex. So that is the advantage with bridge loans. If the property is unstabilized, below 85 occupancy, economic occupancy, or physical occupancy, then we can go with bridge loans. And now most of the deals is bridge loan is not working, so because of high interest rates, high rate caps. So most of the deals now I'm underwriting with permanent agency loans. So mostly loans can be secured from Fannie Mae or Freddie Mac. Typical loan terms are like 5 years, 7 years, or 10 years range, or even 12 years with 30 years amortization. And occupancy should be greater than 85 percentage. Mostly will get for stabilized properties, these permanent options. I will show you one loan terms for one of the deal. Okay. Feel free to ask questions in chat box. So this is the loan term sheets. I got it from broker or lender for same property. Here it is. So if you see here, actual LTV we are getting for 57, 56, 59, 57. So this is, if you see it, this is for Fannie Mae 10 years fixed rate. This is Fannie Mae 12 years fixed rate. This is Freddie Mac 10 years fixed rate 59. Freddie Mac 12 years for 57. So main thing we need to check here are like loan proceeds, how much loan will be getting. If you see that here, total loan amount, this is what we'll get with this kind of interest rate. 57 LTV, that is the amount, and interest rate. So 4.68 interest rate, this is the interest rate we'll be getting. For 12 years, it is 4.86, but we'll be getting a little bit lower loan amount, but we might get high, interest only terms will be more number of years. And Freddie Mac 4.6 lower compared to Fannie Mae, a little bit lower, and also loan amount also will be getting little bit higher. High LTV. Next 12 years, Freddie Mac interest rate 4.83. Then loan amount 7.53 millions. LTV 59. And if we see here, another important component, DSCR, for all agency debts, DSR should be at least 1.25. So that is the criteria it should meet. Okay, very, very important, this one. I'll go back to underwriting model. If we look here, so down payment, so we're underwriting almost 60 LTV. So 60 LTV and 36 months interest only. So that is almost 3 years interest only. Other component we need to check is DSCR is 1.5. Its meeting is greater than 1.25. Okay, and interest rate 5.5. But in current market, at least this size of deals will get around 5.5, and if deal size is smaller, sometimes interest rate will be around 6%. And other thing, capex and reserves are other thing. So here is repairs. We are entering other values, based on OEM. So we are renovating 106 units, and with renovation budget around 7,500, and exterior some miscellaneous or exterior reserves capex budget is 250K, and we are saying with this kind of renovations we can achieve these kind of rents. Delta is on average is 296, from 826 to we are projecting 1125 with this kind of renovations. Always, always we need to check with, always validate with, local PM whether we can achieve this kind of renovations based post renovations. Okay, it's very must. And we need to adjust accordingly if we cannot achieve this one, so how much we can achieve. So I will show a few other stuff here. So we did some rent comes analysis also for this property. Right now this property effective rents are around 829, and these are the rent comps. So these are the 5 or 6 deals within 5 miles range, and average rents we're achieving for comps are around 1140. So this will validate our target rent projections. So the current these rent comps already achieving those kind of rents, so that our projections also valid, I can say. So, and also operating results. Last year, like when Android, I used to take 6 months of expenses, but in current market, I'm doing 1 year capital reserves for safety side. Even like repairs also. If OEM projects 7,500, I'm underwriting with at least more. I'm giving more cushion, so that will help on a rainy day or unexpected. If we face any unexpected repairs or any plumbing issues or any other exterior issues, so that way we can get enough reserves. So, and cap rate, reversion cap rate. So normally we'll get cap rate from broker, and also a reversion cap rate always in current market conditions will be adding 10 bps for each year. So if current market rate is 4.75, I'm adding each year another 10 bps, and we're planning to keep all these properties like maybe 3 to 5 years or 3 to 7 years range. So we can increase that reversion cap rate based on number of years hold. Let me show you. If you say exit strategy, we are planning to sell this like in the 5th year. So going in cap rate is 4.75, but exit cap rate is 5.25. So we are increasing that 10 bps points for each year. So it's almost 50 bps. So that's why its exit cap rate is 5.25. I'll go back to slides. So rent projection we already touched. So other thing we need to consider, we can always check rental comps through apartments.com, validate with PM, few other things also we need to consider, like factors like what is the market occupancy rate, what is the recent rental growth trend, and is it expected to continue at a similar rate. Like last couple of years, rental growth is like 2 digits in North Carolina, like 10%, 11%, or 15%, or something like that. But current year it's not that much. I will show you some data also. So, and what are the population growth projections, down the line. So these other factors also we need to consider when we are projecting the rents. Okay. So there are some other questions we need to ask when we are reviewing rent roll and T12s. What was the estimated cost of the renovation? What rental premium is demanded for these renovations? What kind of timeline we are taking to renovate these units? How many we are doing for each year? or each month, and what kind of deferred maintenance we can expect next 2 to 5 years, uh, and what is the current condition of the property, like roof, what is the roof age, parking lot, any issues with parking lot, any repair, any kind of exterior paints or um, windows, landscaping, amenities, all stuff also we need to consider. Okay. So we touched these stuff like loan to value. There is other option also in current markets, like loan absorption also very good uh, strategy. So because with loan assumption you get low interest rate, right? And most of the times we need it will come under around 45 to 55 LTV. So we need to bring a lot of equity to the table when we are going to loan assumption, like almost 55 to 45 to 55 range equity we need to bring. Uh, yeah, and also maybe if that gap is little bit higher, I mean, if we need more capital, we may go for supplemental loan also, more than 1 million or above 1 million, we can get some kind of supplemental loans. So we covered capital reserves, at least 1x of expenses. Real estate tax will get, we will check with tax assessor, insurance, check the insurance broker, DSCR 1.25. So I will present some kind of data. I got it from local real estate brokers regarding expenses. And these are very, very important data. So we got from local brokers. So these are like controllable and non-controllable expenses. So 50 to 125 units, controllable expenses around 3,100 and non-controllable 2,000. It's coming around above 500, 5K. This is for 50 to 125 units. Let's move on to 125 to 200 units. We're getting controllable expenses around 2,800 and 2,300. It's coming around 5.1 or 5.2. 200 plus units is a little bit lower, yeah, around 4.7, 4,750 something, or 8,000. And these are some expenses compared to 2020, 21, 2020 and 21 versus 2022, 23. If you see delta, so repairs and maintenance little bit decreased, but it's covering contract services increased like almost 36%, and marketing advertising big jump. And yeah, I want to highlight contract services because repairs and maintenance decreased and contract services increased. And insurance also increased most of the states, big jump. And real estate tax also increasing. We can always check with the tax assessor, and if it increases too much, we can always claim those. We can ask to reassess those taxes, and we can ask them to decrease the tax reassessment value. We can claim that. So this is some other data. I got it from some local property management company. They are almost managing 44,000 units. These are some kind of expenses, mainly from expenses. Total controllable expenses around 3,884. So they are managing some A class or B class properties. We can always baseline this data, and we can compare with our underwriting model. So again, like this is like global data, so we can always baseline this historical and this kind of data, and but we need to underwrite with base data is specific to that particular property. We need to underwrite, we need to consider that particular property and adjust these expenses. Okay, yeah. So almost done. Open for Q&A. Feel free to type your questions. Feel free to unmute and you can ask questions. We have a couple of more minutes. And also, I'm launching a coaching program. And okay, Kim, yeah. Okay, let me unmute Kim 1 second. Yeah, Kim.
Hi there.
Hey, Kim.
Yes, for those rule of thumb, what city and state is it in?
Which one? Okay. This is for North Carolina. These expenses, right?
Okay, thank you very much.
Okay, sure. Any other questions? Anyone? And I'm also launching, coaching program. Is 3 months coaching program and it's limited time offer. So it's one-on-one coaching. If you're interested, you can, sign up. And if no questions, and thank you very much, everyone. Really appreciate it. Thank you for your time and joining in your busy schedule, taking time and joining this call. Hope you'll get some value from it and you'll better in your underwriting. Yeah. Thank you. Thank you, everyone.